What's going on, everybody? It's Jeff here. Welcome back to the channel. Waking up on a Saturday morning, seeing crypto having an overnight sell-off right after a tough week inside the stock market. But more importantly, as monetary policies are set to change very shortly, making it harder for hedge funds and institutions to invest in stocks and cryptos utilizing leveraged capital, also known as margin. In this video, I want to break down exactly what happened and where economists see the stock market and the crypto market going, as this margin debt is going to need to come down a little bit. Let's get right into it. First off, as you can see right here, Bitcoin is now sitting at 48,000. It got as low as 42,000. You can see this massive drop right here. It was the entire crypto market. It is very normal for crypto to have these massive spikes and massive drops. As you can see, even Bitcoin here in early to mid-May, it went in about 5 days from 57,000 all the way down to 37,000 before stabilizing a little bit and continuing a little more of a sell-off before its latest rally. I want to highlight this article right here. Bitcoin price tumbles after Wall Street sell-off. Now, there's a couple of reasons for this. One is the Federal Reserve's response to inflation might have played a role. Now, last time interest rates rose, Bitcoin had another massive sell-off in about 2016, 2017. Another possible factor accelerating the Bitcoin sell-off was the unwinding of heavily leveraged crypto derivatives, also known as crypto purchased on borrowed money. Now, the head of market insights at Genesis Global Trading said that she pointed to a large sell order that might have triggered margin calls and liquidations for investors. Now, investors utilize leverage, we all know this, is to make the returns more attractive. They're allowed to make oversized bets with little money. However, when the price falls, margin calls force investors to liquidate. This is a big reason for why some of these crypto experts believe for this sell-off to happen overnight. Now, let me point this out to you as well. Powell's support for a faster tapering, which we just had talked about last week, of the US Fed's bond buying program that will provide less liquidity to the system and tighten financial conditions relatively from the historically loose conditions of the past 21 months, is seen as negative and speculative inside the stock market. Risk assets like stocks and Bitcoin are tanking simply because of this reason. Now, we've talked about the obscene amount of stocks and crypto, stocks more specifically, owned and being purchased on margin. I want to point this out as well, and I was reading this really recently. Leverage is getting tighter. Now, the index is approaching the neutral territory and is nearing zero. It could be also why we have seen margin debt levels beginning to fall, as borrowing on margin to buy stocks may not be as readily available, taking away a significant liquidity source for the equity market. Now, what does all of this mean, as I'm throwing out some of these words that you might be kind of like, just wondering, what are you trying to say, Jeff? Now, first of all, this is not the first time that we have seen massive overnight, over the weekend crypto sell-offs being led by institutions. Now, here's the couple reasons that I have for what exactly is happening. They are facing and or deferring margin calls, margin requirements that need to be met on Monday, Tuesday, Wednesday of next week. Now, crypto naturally is just a little bit riskier of an asset than the stock market. It runs 24/7. As you can see, it can drop 30, 40% in the matter of just an hour. It naturally is a little bit riskier. They don't have circuit breaker halts like the stock market has. So naturally, institutions will unwind some of their positions inside the crypto market world in order to raise liquidity to defer margin calls being made inside the market. Now, what does all of this mean? That the tightening of this monetary policy means that some of these institutions cannot purchase more stocks on margin, or they might have to unwind some of their positions on margin. Well, naturally, when selling occurs, there's going to be a little bit of a dip. It's naturally probably seen it inside the market just last week. But what does this also mean? If they cannot make good on some of their positions that are just over leveraged, that's when the margin calls happen. Now, here's how I see this affecting AMC, because we've talked about the fact that we're waiting for these margin calls to be made. But don't forget, on the positive side, while we want these margin calls to be made, and I think they will be from the very, very small positions, you also have a lot of institutions owning AMC. Okay. Now, if they are looking to sell some of their riskier assets, some of their ETFs, okay, some of their, your blue chip stocks that don't really move that much might not be the first assets they want to liquidate. It could be stocks that are highly speculative, such as tech stocks, high growth stocks, anything that is valued on future revenue, like we've talked about before. But AMC does fall into this category, especially when you have some of the ones that just own, 3,000 shares, 18,000, 15,000, 14,000. They might choose to sell some of their stock in order to make their positions and their portfolios a little bit less risky, as the fact that everybody always wants to avoid getting a margin call. But what does that mean for the institutions that aren't long on AMC, the ones that are short on AMC, as the price is still sitting far above their average short, cost average? That's the ones that they might be able to face some of the margin calls, which are the reasons why we've seen the abuse inside the options chain. Now, I'm not saying a margin call is going to happen. Obviously, we've been waiting for a long period of time. And like I said, it's been almost a year. I wouldn't be surprised if we wait even longer. But just the fact that the monetary policy is changing, they know that the margin debt has to decrease. It's gotten way out of control. It is going to set up for a lot of volatility inside the market. Now, there are a lot of institutions and hedge funds that have a lot of capital on side, and they're not over leveraged. And those are going to be the ones that are going to step in and buy the dip, as it were. Just like you saw with Bitcoin, you have whales outside of the United States that just saw a massive, massive drop. And whenever you see an insane drop going just super, super fast, you know it's going to make a spike. And it's the same thing with an upward movement. It's going to make a big pullback. So you do have that kind of counteraction happening inside. This is going to create a lot of volatility going forward. And as much as the Fed wants to try to keep it as stable as possible, I think that they just kick the can too far down the road. So the next few weeks and few months are going to be very, very interesting going forward. That's it for this one, guys. I'll see you in the next one.